Bonjour tout le monde, je m'appelle Paul Bodicher, je suis directeur pour les relations avec les médias ici à la Banque du Canada. Je vais diriger la conférence de presse aujourd'hui. Le gouverneur Macklem et la première sous-gouverneure Rogers seront ici pour répondre à vos questions pendant 20 ou 25 minutes à peu près. Et le gouverneur commencera avec une déclaration préliminaire et après, on va tourner aux questions. Alors, M. Macklem, à vous la parole.
Thank you, Paul, and good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy announcement and our monetary policy report. Today, we maintained our policy rate at 4.5%, and we are continuing our policy of quantitative tightening. We are encouraged inflation is declining, and we are seized with the importance of staying the course and restoring price stability for Canadians. Inflation is coming down quickly, and it's forecast to be about 3% this summer. The economy is expected to grow modestly, even as inflation comes down. This is good news, but is not job done. Our destination is the 2% inflation target, and several things have to happen to get inflation all the way back to the 2% target. Inflation expectations have to come down further. Service price inflation and wage growth need to moderate, and corporate pricing behavior has to normalize. L'inflation baisse vite et devrait se situer autour de 3% cet été. Malgré le recul de l'inflation, l'économie devrait progresser de façon modeste. Ce sont de bonnes nouvelles, mais on ne peut pas encore crier victoire. Notre destination, c'est la cible d'inflation de 2%. Et plusieurs choses doivent encore se produire pour qu'on l'attienne. Il faut que les attentes d'inflation continuent de diminuer, que l'inflation des services et la croissance des salaires se modèrent, et que la fixation des prix se normalise dans les entreprises. We're focused on these indicators and the evolution of core inflation to ensure that CPI inflation continues to progress toward the target. The work of monetary policy, the full impact of the policy rate increases we've undertaken so far, is not done. We will be assessing economic developments and the effects of past interest rate increases relative to our inflation forecast. If monetary policy is not restrictive enough to get us all the way back to the 2% target, we are prepared to raise the policy rate further to get there. Before I elaborate on these considerations, let me give some economic and financial context for the decision. Since we last updated our economic projection in January, global growth has been stronger than we expected. But while growth in the United States and Europe has surprised us on the upside, economic activity will likely slow further as successive interest rate increases work their way through the economy. Recent stress in the banking sector has also tightened credit conditions, which will contribute to weaker economic growth. Overall, the bank estimates the global economy will grow by 2.6% this year, 2.1% in 2024, and 2.8% in 2025. Au Canada, la demande reste excédentaire. La croissance du PIB au premier trimestre apparaît supérieure à notre projection de janvier. Les exportations semblent avoir bondi et la consommation beaucoup progressé. La demande du travail reste tendue. À 5%, le taux de chômage demeure près de son creux historique et les salaires continuent de monter dans une fourchette de 4 à 5%. La croissance de l'emploi a été plus forte que prévu. Ça reflète le maintien de la demande et les augmentations de l'offre de main-d'œuvre. En effet, plus de femmes ont joint la population active et l'immigration a augmenté. Selon les répondants à notre enquête sur les perspectives des entreprises, il devient plus facile de trouver du personnel. Ça nous dit que les tensions sur le marché du travail commencent à s'atténuer. Past policy rate increases are working their way through the economy to restrain demand. Higher interest rates are slowing household spending, particularly on big-ticket items. As mortgages are renewed at higher rates, more households will feel the restraining effects of monetary policy. Business investment is also expected to soften in the year ahead, dampened by weaker demand for Canadian exports and higher financing costs. Taking these forces into consideration, we expect Canadian GDP growth to be weak for the rest of this year before beginning to pick up gradually through 2024 and through 2025. On an annual average basis, this suggests growth will slow from 3.4% last year to about 1.4% this year and 1.3% in 2024, and then pick up to 2.5% in 2025. This outlook is slightly stronger than our previous projection for 2023, but slightly weaker for 2024. So what does all this mean for inflation? I know many Canadians are still struggling to manage the rising cost of living, and at more than 5%, inflation is still too high. But we've come a long way from the 8% inflation we saw last summer, and we see further declines ahead. Annual CPI inflation declined to 5.2% in February, led by falling goods price inflation. This reflects lower energy prices, normalizing supply chains, and the effects of restrictive monetary policy on interest-sensitive sectors. The more timely three-month rate of inflation has fallen to 1.6%, suggesting headline inflation will continue to ease in the coming months. But price pressures for many things Canadians need to buy are still too high. Food price inflation is still above 10%. We expect that to decline in the months ahead because production and distribution costs have eased. Service price inflation also remains high and is expected to decline only gradually. Continued strong demand for services and still tight labor markets are putting upward pressure on many services prices. As the economy slows and the labor market comes into better balance, we expect to see service price inflation decelerate and measures of core inflation decline further. The bank's preferred measures of core inflation have eased slightly to just below 5%. With three-month rates of core inflation still running about 3.5%, we need to see further easing to get headline inflation sustainably back to the 2% target. This will take some time. We do not expect to get inflation all the way back to the 2% target until the end of 2024. Durant ces réunions, le conseil de direction s'est demandé si les hausses des taux effectuées étant suffisantes. On a aussi parlé du fait que la politique monétaire va peut-être devoir rester plus longtemps restrictive pour ramener l'inflation à la cible de 2%. Le conseil de direction a ainsi jugé bon de maintenir les taux pendant qu'il évalue si la politique monétaire est assez restrictive pour permettre le retour à la cible d'inflation. On sait que les effets de resserrement monétaire sont décalés et ils ne sont pas encore complètement propagés dans l'économie. Governing Council discussed whether we've raised rates enough, and we considered the likelihood that the policy rate may need to remain restrictive for longer to return inflation to the 2% target. With these considerations in mind, Governing Council judged it appropriate to hold the policy rate steady while we continue to assess whether monetary policy is sufficiently restrictive to return inflation to target. Monetary policy works with a lag, and we recognize that the effects of the tightening have not yet fully worked their way through the economy. Governing Council also discussed the risks around our projection. The biggest upside risk is the one I just mentioned, that service price inflation could be stickier than projected. If the labor market remains tight and companies believe they can continue to pass on higher costs without restraint because consumers expect higher inflation, then getting inflation back to target will be more difficult. The key downside risk is a global recession. If global banking stresses reemerge, credit conditions could tighten significantly, resulting in a more severe global slowdown and much lower commodity prices. Overall, we view the risks around our inflation forecast as roughly balanced, but with inflation still well above our target, we continue to be more concerned with upside risks. So let me conclude. Our job at the Bank of Canada is to get inflation all the way back to the 2% target. We are encouraged with the progress so far. And getting inflation down to 3% this summer will be welcome relief for Canadians. But let me assure Canadians that we know our job is not done until we restore price stability. That means inflation is centered on the 2% target. Price stability is important because it restores the competitive forces in the economy and allows Canadians to plan and invest with confidence that their money will hold its value. That's the destination. We're on our way, and we will stay the course. With that summary, the Senior Deputy Governor and I would be very pleased to take your questions. Thank you.
Okay, thank you, Governor. We will begin our questions in just a second. There are a fair few number of reporters here with us at the bank. We also have some on the phones as well. We'll start in here in the room and then go to the phones. Governor's time, unfortunately, is quite limited today, so in order to get every organization a question, I'm going to ask you to limit yourself to one question only, please. If I forget to do so, please state your name and affiliation. I'll just remind people on the phones to please mute your line once you've finished asking your question. And again, it's the *6, pressing *6 on your phone that will toggle you between muting and unmuting. Pour mettre votre ligne en mode discrétion, appuyez sur *6 et pour l'enlever, faites *6 encore une fois. Avant de poser une question, veuillez vous identifier et libre à vous, comme toujours, de poser vos questions dans la langue officielle de votre choix. Last thing, for reporters who just joined us, if you have not confirmed your desire to ask a question on the phone, please let us know by sending a quick email to communications with an S at bankofcanada.ca. We'll do our best to put you in the queue. Having said all that, let's start here in the room. Our first question is Steve Scheer from Reuters. Please go ahead, Steve.
Good morning, Governor. I wanted to ask about language that had been in the last NPR in January about the possibility of two consecutive quarters with negative growth being about the same as two with positive growth. That's not in this NPR. So I'm wondering, does that mean that you're ruling out a recession for this year, or that it's much less likely? Can you say a bit about that, please?
Yes. So as I highlighted in my opening remarks, we are seeing inflation come down even as the economy continues to grow. That is encouraging. But yes, growth, we do expect growth to be weak. It's expected to be weak through the rest of the year, pick up gradually over the course of next year. I would remind you that we actually need a period of weak growth. We need growth to be weak to let supply catch up and relieve price pressures. With respect to the details of the forecast, if you look, I mean, I would say the high-level message is that the outlook for growth has not changed very much. Growth came in a little bit weaker in the fourth quarter than we'd expected. It looks like it's going to be stronger in the first quarter than we expected in January. We're expecting pretty weak growth for the rest of the year, something a little less than 1%. So what does that mean? I mean, we're forecasting small positives. When you're forecasting small positives, you can't rule out that there's going to be a couple quarters of small negatives. We're not forecasting a major contraction. We're not forecasting large increases in unemployment. And in that sense, it's not what people associate with the word recession. Our baseline forecast is for positive but weak growth and declining inflation.
Our next question will be from Raul from Epoch Times. Go ahead, please.
Yes, hello. Thank you for taking my question. It's sort of similar in that, you've reallocated the growth between 2023 and 2024, but as you said in this speech, not much of the 425 basis points of rate hikes has fully taken effect in the economy. And if we think about that, the lag, if it's 12 to 18 months or whatever, then the weakest of the growth you're getting is in 2023. But then you figure that it picks up even as more of those rate hikes take effect, and then 2025, 2.5% growth. So can you just explain how even after the 425 basis points of rate hikes take effect, that the economy will increase to 2.5% growth?
So we started raising rates more than a year ago. So a little more than a year ago. So, we're well into that period. Yes, the most recent increase was at the start of the year. But, we have been raising rates now for more than a year. It is feeding through. Yes, when we look at the lags, that's the full effect comes through in 18 to 24 months. We are seeing effects now. You can certainly see, it very clearly in the housing market. You can see it in the effects, consumer spending on big ticket items, things you usually buy on credit. That's where you'd expect to see it first. Those are the interest sensitive sectors. You're starting to see a little bit of some broader effects on consumption, a little bit on services. And certainly when we go out and we survey households, what they tell us is that they are planning to cut back on discretionary spending, recreation, restaurants, things like that. So we are expecting to see further slowing going forward. Why it picks up? It's pretty weak through really the rest of this year. It starts to pick up gradually through 2024. And it's really in 2025 where we have 2.5% growth. That really reflects a few things. Those effects of higher interest rates on growth are starting to fade. Global economy is picking up. There's more export demand. Those things, growth resumes. And keep in mind, growth is going to be resuming with inflation around the 2% target.
Okay, we'll go now to Jordan Gowling from CTV, please.
Hi, Governor. Thanks for taking my question. The NPR highlighted a high level of household debt, with debt servicing costs up $133 billion, 45% from last year. How worried are you about that if the downside risk does occur and a significant global slowdown happens?
Yeah. Senior Deputy, why don't you take that one?
It's important to keep in mind when you look at those numbers that a big amount of that increase has occurred. The variable debt is the debt that reprices soon as monetary policy takes effect. What you are seeing and what you see in the box in the NPR is that effect sort of broadens out as mortgages renew at higher rates. So that is monetary policy at work. We do need to see, as the governor said, that sort of dampening in demand to get the economy back in balance. We have, though, for quite a while now talked about high levels of household debt being a vulnerability, and it is something that we need to watch as the economy adjusts to higher interest rates.
Okay, we'll go now to Mackenzie Gray from Global, please.
Thanks for taking our questions. In a similar vein, just what's your general view on the housing market? And as you were speaking about before, there are lots of Canadians who are going to be at a low mortgage rate now who are going to have to renew at a much higher rate. How much is that a concern for the bank?
Well, I'm going to start with the same reminder I always do on housing, which it's important to keep in mind the starting point. We saw, unusually high, unsustainably high levels of housing activity and house price increases through the pandemic. Over the last year, we've seen that retrench a bit. Both activity and prices have come down. They're still above where they were at the beginning of the pandemic. And certainly, as Canadians renew their mortgage, that affects spreads, as I just said. So it will have an effect on household disposable income. That'll bring down consumption, but that is monetary policy sort of taking effect, bringing demand down in the economy and restoring that balance we need to get inflation back to target.
We'll go now to Randy from Bloomberg, please.
Hi. Why was the more explicit conditional language around rate pause was removed from the statement?
Well, I think I'll look at exactly what we said. When we announced, I don't think there's really much to it. We had been raising rates. We announced a conditional pause to signal that we were, pausing to assess whether we'd done enough. We're now in that pause. We held rates we held rates today at 4.5%, and we've indicated that we are continuing to assess whether monetary policy is sufficiently restrictive to get inflation back to target. I'd underline we also discussed the likelihood that interest rates, monetary policy needs to remain restrictive for longer to get inflation all the way back to the target.
Okay, we're going to go to Mark Rendell now from the Globe and Mail. Please go ahead, Mark.
Following up on that question, when you said the Governing Council discussed having to potentially maintain interest rates at a higher or at the level they are for longer, what was the outcome of that discussion? I mean, what is the general sense that you're having right now? I guess both about whether rates are high enough, but more the second part, whether we're in a higher for longer period, given what you're seeing in the forecast.
Well, the decision we had to take today was what to do with interest rates today. So that's, that was really our primary focus. But of course, when you're taking a decision today, you have a forecast, you do look forward. We're going to take those future rate decisions in the future with the benefit of all the latest available information. But what I can say about our deliberations is that based on the information we have today, the implied expectation in the market that there are going to be that we're going to be cutting our policy rate later in the year, that doesn't look today like the most likely scenario to us.
Okay, next we'll go to Najoud Al-Malis from the Canadian Press, please.
Hi, Governor. There's been a lot of focus lately on the strength in recent economic data, the upside surprises that people maybe sometimes are not used to. I'm wondering if you could weigh in on how you square off that strength with the unchanged forecast in inflation. And I guess, I'm wondering if the strength relates to what you just said about potentially having to keep rates higher for longer.
Yeah, a couple things. So, as I mentioned earlier, GDP growth in the fourth quarter came in weaker than we'd expected, came in 0. It looks like it's going to be stronger. The first quarter is over, but we don't have the first quarter yet. But if you look at a variety of indicators, strength in labor market, consumer behavior, it looks like first quarter growth is going to be stronger, something a little over 2%. We do continue to forecast that through the rest of the year it's going to be weak, something averaging less than 1%. It was a little weaker in the fourth quarter. It's stronger in the first quarter. We still think it's going to be weak. You kind of average all that out. It hasn't changed that much. But yes, on the margin, we have revised growth up for this year, and you can see that in our growth forecast. And the other thing is that the labor market has remained very tight. Unemployment rate is still at 5%. We are, when we talk to businesses, we are hearing that they are starting to find it easier to find labor, and with stronger population growth, more temporary foreign workers coming into the country, I think that is contributing to the strength we're seeing in employment at the same time as you're seeing vacancies come down slowly. But with GDP growth a little stronger, with the labor market still tight, that means it could take a little longer to get inflation down, and that is reflected in our forecast. If you go back to January, we had forecast inflation. We said inflation would come back to target in 2024. We've now said the end of 2024, and that really reflects the fact that there are a number of things that still have to happen. Inflation expectations, yes, they are coming down, but they're still higher than our own forecast. They've got to come down some more. Wage growth has been running at 4 to 5%. Unless there's a surprising acceleration of productivity, that's not consistent with 2% inflation. That needs to moderate. Service price inflation needs to come down. And when you look at corporate pricing behavior, again, it is starting to normalize. You're not seeing as many big price increases. The frequency of price increases has gone down. But when we talk to firms, they're still telling us they've got cost pressures and they intend to pass those through. So it has not yet normalized. So we need to see those things come into place to get inflation all the way back to target. And that looks like it's going to take some time.
Okay, we'll go next to Paul Vieira of the Wall Street Journal.
Governor, in the survey that was released last week measuring consumer expectations, consumers surveyed indicated that they feared that elevated government spending would hamper your ability to reach its 2% target. Do you agree with that assessment?
Well, we provided more detail than usual around the contribution of government spending to growth. So let me say a few things. But the first thing, let me underline, and I can't stress this enough, fiscal plans are the responsibility of governments, ultimately parliaments. Governments have a lot of priorities. They have difficult choices to make, and it's not our job to comment on those choices. But it is our job to control inflation. So you know, I'm certainly prepared to talk to the implications of fiscal decisions for inflation. So as we usually do when governments put out budgets, we incorporate those in our projection. So this projection takes into account the various provincial and federal budgets that have come out recently. And those budgets altogether add about $25 billion of additional fiscal measures over the next 3 years. And you can actually see in our projection that that shows up in higher contribution to growth from government spending. If you look in Table 2, you'll see the contribution of growth from government is a little bit stronger. Now, regarding the effects of fiscal measures on inflation, you know, one way to look at it is to look at, so what is the rate of government spending relative to the potential growth in the economy? So we think potential growth in the economy is about 2%. And if you look at the second half of last year, government spending came in at roughly 3.5%. So that is considerably above potential growth. If that were to continue, that would boost aggregate demand, and that could make it more difficult to get inflation back to target. When we've incorporated the new fiscal plans of various levels of government into the projection, growth in government spending in the projection over the next year starts at about 2.5, goes down to about 2. So it's broadly in line with the growth in potential output. So to get back to your question more specifically, how would I sort of roll this all up? The way I would put it is that government spending plans are not contributing to the slowing of growth that you see in our projection. But at the same time, they're not standing in the way of getting inflation back to the 2% target. This projection incorporates those new fiscal plans, growth slows, and inflation comes back to target by the end of 2024.
Okay, unless I'm missing anyone, I have 2 questioners left here in the room. The first will be Greg Quinn from Market News. Please go ahead, Greg.
Good morning. The statement mentions a host of factors behind what's keeping inflation elevated. Wages, inflation expectations, aggressive corporate pricing, services. Is this a case where you already have a good deal of evidence that could justify another rate increase?
Well, we didn't raise interest rates. We've stayed at 4.5%. We are conveying that we are using this pause to assess whether we've done enough. And as I mentioned in our deliberations, we also considered the likelihood that policy might need to stay, or interest rates might need to stay elevated for longer. With respect to the overall accumulation of evidence since January, if you look at inflation, it's coming down, and the recent data has reinforced our view that we expect inflation to be around 3% this summer. That's a pretty rapid decline. If you look at the real economy, as I conveyed to in other questions, growth is expected to be weak, but we have revised up our outlook a little for this year, and labor market does remain tight. So, that does mean that those adjustments that you just mentioned, they could take a little longer, and that's reflected in our forecast. It takes a little longer to get inflation all the way back to the target in our forecast. I think what we're highlighting is those are things we're watching closely. For some of them, we're starting to see some movement. As I mentioned, inflation expectations are coming down, but they're still above our forecast. They're not coming down as quickly as we think inflation's coming down. And they've got to come in line with the target to get inflation back to target. Corporate behavior, it's normalizing, but it's not normal yet. Wages have not started to moderate. So, those are the things we're going to be looking at. Core inflation provides a good sort of summary of the underlying trend in inflation. So that's something we'll be looking at as well. And, those are the things that those will be the key things we'll be using to assess whether we think interest rates are high enough to get inflation back to target.
Okay, and our final question here in the room goes to Kevin Carmichael of the Financial Post. Go ahead, please, Kevin.
To what extent did the banking turmoil over the last few weeks factor into your decision today? And a quick, I'll double barrel the question. To what extent does that turbulence or that sensitivity factor into your policy decisions going forward?
Yeah. Carolyn, why don't you take that one?
Thanks for the question, Kevin. So, the immediate effect of banking stress and particularly what happened in early March is really a focus on financial stability. The confidence effects, the potential for runs. Fortunately, both the U.S. and the Swiss authorities intervened quickly and contained that sort of contagion, that immediate contagion effect. Having said that, sort of the holdover effect, you've seen spreads widen out, you've seen sort of funding costs for banks go up, and there's still a bit of pressure on bank stocks. So what that usually results in is a bit of a pullback in lending in the banking sector. So then, the effects really start to move more into growth. In our forecast, we expect to see that primarily in the U.S. and to a lesser degree in Europe, and that will feed through overall to growth. So in that sense, it factors into our monetary policy thinking in terms of the overall picture. But for now, at least, the immediate stress has been contained, and that's a good thing.
Okay, we're going to go to the phone lines now. The reminders there for everybody, *6 is how you toggle between muting and unmuting. Our first question is going to come from Paul Bagnall of BNN. Paul, go ahead, please.
Thank you, Governor Macklem, for taking my question. We're carrying the press conference court live here on BNN Bloomberg. I spoke to a couple of people today shortly after 10 a.m. Eastern Time, one a senior bank economist, one a former finance minister of the Government of Canada. Both of them pointed to the fact that there are very large labor negotiations pending or soon to get underway at the federal level with public civil servants and at some provincial governments as well. They both made the point that wage settlements or pay settlements there greater than the bank's target on inflation could make the bank's job more difficult in taming inflation. I know you don't want to get in the middle of labor negotiations, but can you comment on labor settlements and wage pressures in Canada?
Well, you're right. I'm not going to comment on any specific labor negotiations, but I will reiterate the message that we've been conveying all along. This is the message. We've been giving the same message to businesses, to workers, to governments, and that is inflation is coming down. Don't plan on inflation staying high. Inflation was 8% last summer. It's about 5% now. We think it's going to be around 3% this summer, and we are resolved to restore price stability. And what that means is that inflation will once again be centered on our 2% target. And in our own forecast, that happens by the end of 2024. So whatever you're doing, if you're a business setting prices, if you're in wage negotiations, you're planning your own budget, our message is plan for inflation to come back down, plan for price stability.
Okay, our next questioner is Kat Eschner from TV Ontario. Go ahead, Kat.
Hi there. Thank you so much for taking my question. What I'm wondering is, in the current circumstances, in the current economic circumstances, what signs will tell the Bank of Canada that maximum sustainable employment has been reached?
Well, maximum sustainable unemployment, unfortunately, is not something we can observe directly. It's more of a concept than a number. In practice, what we do is we look at a whole range of indicators to assess the tightness or the slack in the labor market. And when we look at those broad range of indicators, what they suggest is the labor market is still tight, and so, what that means is that it is probably operating above maximum sustainable employment. We need to see some rebalancing in the labor market. We need to see some easing in the labor market to take out those wage and price pressures and bring inflation back to target. Where are we in that process? If you look at the big macro indicators like the unemployment rate, it hasn't budged. It's still 5%, and employment growth has been strong. When you talk to firms, what you hear is they are starting to see some easing. They are starting to find it's a little easier to find workers. We also know that population growth has increased a lot. Companies are using the temporary foreign worker program more. That is probably helping ease this tightness in the labor market. Now, at the same time, and what that means is on a monthly basis, when those employment numbers come out, that means you probably have a higher sort of run rate of employment growth month to month without creating inflationary pressures. But when you look at it for the economy as a whole, of course, those new workers, those new immigrants, they're also consumers. They're renting, they're looking for houses, they're buying food, they're buying other things. So they're adding to demand as well. So monetary policy's still got some work to do here to get the economy back into balance and get inflation back to target.
Okay, we're now going to go to Alicia Sikirska from Yahoo Finance. Alicia, please go ahead with your question.
Thank you so much for taking my question. Following up on the population growth, what are you watching for when it comes to the impact of the population growth that we have been seeing in Canada that has been so strong? And are you concerned about any impact it may have on trying to wrestle demand down?
Well, as indicated, population growth, labor force growth, immigration, it's adding to both demand and supply. So in the labor market, you can certainly see with higher levels of immigration, more temporary foreign workers, that is sustaining. It's making it easier for firms, for businesses to find the workers they're looking for. We've seen strong employment growth. And when you talk to companies, as I indicated, while they certainly still find labor markets tight, they are finding it easier to find the workers they're looking for. What they report is they're seeing a little less competition for workers and more availability of labor supply. But as I mentioned, those workers, they're also consumers, so they're also adding to demand. And so yes, we're having to look at both sides of those things. I think when you add it all up, though, what it means is that the economy can grow faster without generating inflationary pressures. Potential output growth is higher than it otherwise would have been. But it doesn't, if the economy is in excess demand and you add both to demand and supply, you don't get rid of that excess demand. And in that sense, monetary policy still has some work to do to get the economy in better balance and get inflation back to target.
Bon, passons maintenant à Olivier Ferrand-Boisset du réseau TVA. Monsieur Ferrand-Boisset.
Bonjour. On n'entend pas.
C'est étoile 6 pour... Monsieur Ferrand-Boisset?
Oui, bonjour.
Ah, voilà, on entend.
Génial, merci. Merci de prendre nos questions. Vous parliez plutôt de l'importance du contrôle des salaires. Ça survient au moment où il y a des fonctionnaires qui se donnent un mandat de grève, où on demande des hausses salariales assez importantes. Là, on parle d'une proposition de 9 sur 3 ans. J'aimerais savoir si ce genre de hausse-là était généralisé, était aussi applicable à d'autres secteurs au pays. Est-ce que c'est le genre de hausse qui pourrait avoir un impact sur votre chemin de retour à la cible d'inflation?
Quand on regarde l'économie en total, qu'est-ce qu'on voit? Que les taux de salaire montent dans une fourchette d'à peu près 4 à 5 et qu'est-ce que nous avons souligné, c'est que on a besoin, ce serait important que le taux d'augmentation des salaires modère pour retourner l'inflation au cible de 2 c'est pas notre rôle de rentrer dans les négociations salariales et c'est pas à nous, les entreprises ou les gouvernements, quoi payer leurs employés. Mais c'est notre rôle de contrôler l'inflation. Et qu'est-ce qu'on voit? Notre message, c'est que l'inflation est en train de baisser. Nous avons déjà baissé de à peu près 8 à environ 5 On anticipe que l'inflation sera environ 3 cet été et on est très clair aujourd'hui que nous retournera l'inflation au cible de 2 vers la fin de 2024. Donc, qu'est-ce que je peux dire, c'est qu'un aspect important pour retourner l'inflation à notre cible de 2 c'est de trouver un meilleur équilibre dans le marché de main-d'œuvre et que les salaires, le taux de croissance des salaires commence à diminuer.
Okay, and our final question, as we're just about out of time, our final question is from Reed Southwick of CBC. Go ahead, please, Reed.
Hi there, can you hear me?
Yes, go ahead.
Oh, wonderful. Yes, great. Mr. Macklem, earlier you said that you do not expect that a cut, you think that a rate cut down the line is not likely to happen. I'm wondering why. Why don't you think that's in the cards?
Well, I think a key message is inflation is coming down. We, as I said a number of times, we expect it to be around 3% this summer. That is going to be some relief for Canadians. But the destination is not 3. The destination is 2. It's to restore price stability. It's really important that we do center inflation around 2%. And there are a number of things that still need to happen if we're going to get inflation back to 2%. And we are seeing some progress on those things. I mean, and I've gone through them. You know, inflation expectations need to come down. Wage growth needs to moderate. Service price inflation needs to decline. Corporate pricing behavior needs to normalize. We are starting to see progress in those elements, but we're going to need to see more progress if we're going to get inflation down to the 2% target. And so what that means is that it may be necessary for interest rates to stay elevated for longer to get that job done. We're going to take those future interest rate decisions in the future, but as I said earlier, when we look at the information we have today, the implied interest rate cuts that are built into the market curve later this year don't look like the most likely scenario to us. Thank you very much.
And we are out of time. Thank you all very much for joining us. Thank you, Governor, Senior Deputy Governor. We'll see everybody next time.